All right, so let's go to the second chapter, which is chapter 2. In chapter 2, we'll be looking at preparation of final accounts. So we're looking at final accounts. So let us look at the learning objectives of this chapter. So the first thing you are supposed to know by the end of the chapter is you should be able to understand what items is to be included in the financial statements. So what items are supposed to be included in the financial statements? And the second thing is to remind the students on how to prepare a financial statement in association to IS1. So it's a reminder, something that is not new. It's revision to us. So we're just gonna talk about, remind each other how we prepare our financial statements. So when we're talking about a full set of financial statements, right? We are talking about 5 statements, right? The first statement is statement of profit or loss and other comprehensive income. That's the first statement. So this statement, right, we'll call it statement of profit or loss and OCI, other comprehensive income. So what does this statement do, right? Right, this one shows the financial performance of an entity. Over a period. Usually it's a period of 1 year. So over a period. Accounting year runs for a year, right? So it's over 1 year. So in the statement, we'll find items as revenue, right? Also called as income and expenses. So the difference is what is called profit or loss, right? We'll also look at the part of other comprehensive income. Other comprehensive income include items as revaluation gains. So other comprehensive income are basically, we're saying that we cannot categorize them as income because they do not run in normal course of the business. 1. 2 is that they are not realizable. That's the other thing. They are not realizable, right? They are not realizable. They are unrealizable. That's why we put them in another heading. Because if we are saying that revaluation, if you remember about revaluation, but we will talk about revaluation later on. If we are saying that we have a car, we bought it at 1 million. Now we have revalued it to 2 million, and we still have the assets. There's no income that we have gained from we have just changed the price, right? We have just changed the price. That's why we're saying that this income is not realized. That's why it's not included in other incomes there. It's included on its separate line called other comprehensive incomes. Unless if we sell this car at 2 million, now the unrealized gain will be realized. That means it will move from being other comprehensive income to being income. That's why it's shown in a separate line. So we have statement of financial position. So this statement will be showing statement of financial position, SFP, right? This statement is showing the financial stand of an entity. On a particular date. So we want to see how many assets does a company have on a particular date. How many liabilities does a company have on a particular date, and how many capital or equity does a company have on a particular date. That's to do with financial position. So we have another statement called statement of cash flow. So this statement of cash flow, is also showing performance of a company, right? It shows the performance of a company. Another distinct feature about statement of cash flow, right? It includes only money transaction, right? Cash transaction. When there's been a payment, that's when we are going to record, right? Whenever there's a payment, we are going to record. If there's no payment, we are not going to record that expense until it is a payment. So we are going to say it only includes cash transactions. So just to say something, it's, for example, if I buy a car and I pay for it, it will go into the statement of cash flows, right, as an expense because there has been cash related movement if I buy a car. Wow, if I went to the profit or loss, I will not have to include the expense in that year. Rather, I will capitalize the asset, but when I say capitalize, I mean it will appear in the statement of financial position. That's why it goes under asset. But yearly, I'm going to show an expense of depreciation. Here I'll be showing depreciation as an expense. We'll talk about this in detail when we come to see these statements. Right? Let's talk about the other statement. We're talking about changes in equity. This also shows the performance of a company. Statement of changes in equity shows the performance of a company. Right? Over a period. The period is 1 year, right? Over a period, let's say 1 year. That's the accounting period. Right? The other thing is it will show the movement of equity during the period. So when I talk about equity, all those that appear under capital, that's equity, because equity is the same as capital, right? So we're going to see when equity is basically a term used for companies, right? While that capital is a term used for a sole trader and the partnership, an incorporated company. So when we are looking at incorporated company, that's where we're going to see changes in equity. We'll see stuff like movement of shares, movement of other reserves, movement of retained earnings account, movement of revaluation surplus, stuff like those. So we'll look at it in detail. So the other last statement is the notes to the account. So the notes to the account is basically includes narratives. When I say narratives, written descriptions, right? Written descriptions, right? You are trying to narrate whatever figures there are in a financial statement. Narratives. Disclosures also appear there. Some items that are not included in the financial statement will be needed to be disclosed in the notes to the account. So this is a supplementary statement that enhances the other financial statement. So we're saying it's a supplementary statement that enhances the other 4 statements, because we're saying it is adding more meat to the other 4 statements, because it is trying to explain whatever is already in the financial statement, or is trying to disclose other items that has not been included in the financial statement for whatever reason. We'll see some of the reason why we are not supposed to include it in the financial statement, but we should include it in the notes to the account. So those are the statements. So let us talk about how do we actually come to draw up financial statement. What is the process? So I'll talk about the flow of information until we come up with financial statement. In the flow, the first thing is coming up with the source document. Source document. We have the source document. The source document can include items as invoices, goods received notes, credit notes. Stuff like those are called invoices. So after the invoices have been drawn up, you are going to record the invoice into the first book called Book of Original Entry, or the day book. Book of Original Entry. After the source document, you're going to record them in the first book called the Book of Original Entry, or known as the day book. We already have an idea how many day books are there. We have the sales day book, we have the purchase day book, retain inwards day book, retain out of day book, journal. Those are the day books I'm talking about. From the day books, they will have to transfer this information to the ledgers. The ledgers. We have 3 types of ledgers. We have the nominal ledger, nominal ledger, nominal ledger. The other is the sales ledger. The last one is the purchases ledger. We already looked at this, so I'm not going to explain. I'm just trying to remind each other the flow of information until we reach the financial statement. From the ledgers, we are going to transfer this to the first trial balance, called the unadjusted trial balance. I'll call it TB, trial balance. You're going to transfer this to unadjusted trial balance. We call this unadjusted trial balance because we have not adjusted for year-end adjustments. So some of the year-end adjustments are items like depreciation, right? Showing closing inventory, stuff like those. Showing prepayments and accruals. That means we haven't adjusted for such year-end adjustments. After that, we come up with the adjusted trial balance. Now we come up with the adjusted trial balance. It's the trial balance now that we have adjusted for year-end adjustment, like for depreciation. We have adjusted for prepayment and accruals. We have adjusted for other year-end adjustments. From here now, we can come up with the financial statements. That's the flow. So just a quick through the flow. So we're saying source documents to the book of original entry, to the ledger, to the unadjusted trial balance, to adjusted trial balance, now to the financial statement. That's the flow. So because in this chapter we're focusing our attention on our financial statements of a sole trader. Financial statements of a sole trader. For this chapter we're focusing on that. Financial statements of a sole trader. So we are going to look at the first 2 statements. We're just going to focus on the first 2 statements because these are the statements that a sole trader is supposed to prepare. The first 2 statements. But when you go to a company, we have to prepare all of them. So let us focus our attention for the two. So let's just see what a statement of profit or loss and other comprehensive income is all about. So this starts with income for the whole year. I said that we're going to show income of the whole year. Then we're going to show the charges that have helped earn the income, right? Or the expenses that have helped generate the income, which is called cost of production. Cost of production or cost of sales. If we subtract this, we are going to find the gross profit. So it's income or revenue minus cost of production. We should find the gross profit. After finding the gross profit, now we will subtract all the other expenses and we find the net profit. That's how it's supposed to be. So let us see a pro forma, right? How a financial statement of profit or loss and other comprehensive income should look like. So the first thing with a statement of profit or loss and other comprehensive income is to write up the title. So the title does describe that it is showing the financial performance over a period. So we'll look at the wording, right? It says statement of profit or loss and other comprehensive income for the year ended 31. Have you seen? It is covering a period of a year. It's covering a period of a year. That means if you see revenue, those revenues are for the year. If you see expenses, those expenses are for a year. So let us now come into detail of the financial. So we're going to start with revenue. You put it there. Then you have to adjust it. If other customers have returned other stock to us, right? Called the return inwards. So I think customers have returned. So initially we had recorded them as sales. Now they have returned. So we have to adjust for return inwards. So you find the adjusted, right, revenue figure. After that, we have to subtract cost of sales. So we quote this as charges or expenses that have helped in the generation of this income, right? These are charges that have helped in the generation of this revenue that we are talking about, cost of sales. So for us, cost of sales, we start with opening inventory, right? We have to come with the purchase figure. But the purchase figure can be adjusted also. Can be adjusted before we actually put it here, right? It can be adjusted. We should add any carriage inwards. So carriage inwards are expenses that are incurred for you to bring your stock or whatever material to your premises. For example, I buy my wood from a company, Reply, right? I stay in Lilongwe and Reply is in Blantyre, right? So I book a tractor to carry it. So the expenses of carrying that wood to Lilongwe is the carriage inward. That should form part of my purchases, right? And we should subtract any return outwards. If I have retained some of the material or some of the stock, for example, I find 40 items of the wood, so I'm returning the wood to Reply. This is called return outwards. So we have to adjust for it, and the figure is the adjusted figure for purchases, and it will go in line with opening inventory. Now we'll subtract closing inventory. And if you subtract that, we're going to find the figure for cost of sale. That will go in line with the revenue figure. And when you subtract these two things, you should find your gross profit. That's our gross profit. Revenue, adjusted revenue minus cost of sales. That's our gross profit. Now, we have to add other incomes, right? Other incomes. Because the incomes that have been mentioned here right, are the income that relate to the general operations or the core operation of a company. For example, Illovo Sugar sells sugar. So those are the core operations of the company. But they might generate other incomes. For example, they have an office building which they have not occupied the whole building. So they decide to rent it out. So the income from that can be included there. So let us talk about other income. So we can include profit on disposal. If we have sold any non-current assets and there's a profit, we include it under other incomes. Rent receivable. Like I was saying, I have an office building that I've not occupied the whole, or have a new building that I've built, but nobody is in there. So I've rented it out. So the money that I'm receiving there is income, but is not the core business, core activities of my business. So it should be appear on other income. Bank interest. If I leave my money in the bank and it earns interest, it should also shown as income but under other income. For example, another thing is bad debts written off but recovered. So initially I had written off some bad debts, but the bad debts have decided to eventually actually pay us. So those ones should be treated as income. Same applies to any decrease in provision of doubtful debt. That means initially we had estimated a higher figure. For example, I estimated 100,000 that these ones are not gonna pay up. But at the end of the year, I assess that the figure has gone down. So the difference here should be treated as other income. So let's go to expenses. So we go under expenses. We have rent, wages, electricity, carriage outwards. So we saw carriage inwards should form part of purchases, but carriage outwards, we're saying that these are expenses related to us trying to deliver items to our supply. For example, Illovo Sugar is trying to deliver to a certain company. Let's say it's trying to deliver to Sana. As it's an expense to them, they're trying to deliver to Sana. So carriage outwards is supposed to be treated as an expense. Depreciation has to be appear. Bad debts, increase in provision. That means we estimated a lower figure of doubtful debts, but we have assessed that it has increased to 100,000. So the increase has to be shown as an expense. And other operating. You can add up all of these expenses and come up with the total expenses and subtract with the total income to find your net profit. After that, now we can include the part of other comprehensive income. Other comprehensive income, we're going to look at revaluation gain. Whenever we have revalued an asset and there is a gain, it will be shown in a separate line as other comprehensive income. I said we are not supposed to include in the incomes because this one is unrealized. So if we are going to include it as realized income, we have misinterpreted or misrepresented our financial information. So we have to separate this. So if I add up the net profit plus our other comprehensive income, we should find total comprehensive income. That's how the pro forma works. So let us continue and see a statement of financial position. Statement of financial position. So this is the other statement that a sole trader needs to actually prepare. Statement of financial position. So in this statement, we're saying that it is showing a list of all assets, liabilities, and equity. I said that this statement will show the financial stand on a particular date. That's why it is said to be a snapshot of what a business is worth. Snapshot of what a business is worth. A snapshot is the same as a screenshot. So, have you realized how a screenshot works, right? I can take a screenshot of a video, but it will only show me that scene right there. Just that scene. That's what the financial statement will do. It will show us a financial position of a company on a particular date, right? Unlike the statement of profit loss where it's covering a period of 1 year, this one is going to be telling us what assets are there on a particular date and what liabilities are there on a particular date, and what equity is there on a particular date. So that's what's to do with our financial position. So let us look at a performer that illustrates the financial position. So the financial position, we'll start with the heading as well. So let us look at the heading, the wording of the heading. That actually shows that it is talking about a particular date. The statement of financial position as at 31 December. It's different from that one. They say that for the year ended 31 December. That means they're saying that for the year that is ending 31 December, meaning from 1 January to 31 December, that's the year that we're talking about. But for this one, they're saying as at a particular date, as at 31 December. What assets do they have on 31 December? Not on 30 December, no. Not for the whole year, no. But on 31 December, what assets do they have? What liabilities do they have? And what capital equity do they have? So we're going to start with assets. We'll start with non-current assets. So we'll start with property, plant, and equipment. This is just a summary. When I say that property, plant, and equipment is a class that is talking about all tangible assets. That means cars will be there. Fixture and fitting will be there. All those tangible assets will be under property, plant, and equipment. Maybe when we are preparing for a sole trader, we might break them down. We might show cars separately. We might show fixtures and fittings separately. But for a limited company, we'll show them together. So we'll also show tangible assets. That means all tangible assets will also be classified together. But for a sole trader, we might split them, right? We have goodwill. We might have brands and whatnot. So we'll show our cost, how much we paid for, minus our accumulated depreciation. The answer should give us the net book value or the carrying amount. So we're going to add all our non-current assets. So we'll go to our current assets. So we have inventory, receivable, prepayment, bank, and cash. So the arrangement needs to be like this because we are supposed to arrange them in accordance to their liquidity. So we are going to start from the less liquid, which is the inventory, to the more liquid, which is the cash. So we're going to show them and add them up and show them in line with the non-current assets. And together we're going to add and we're going to find the total assets. After that, we're going to look at capital and liabilities. So we're going to start with the capital. We can adjust our capital by any profit that we have made during the year, right? So less drawings. If you have made any drawings, has to reduce, right? If I've made any new contribution as capital, I have to add, and that figure will be my revised capital figure, right? Now I will show any revaluation that is there, any revaluation account. I can also have other reserves, right? Maybe replacement reserve. You might be keeping a certain amount of money so that you can replace a particular asset, or general reserve. You are just keeping without a specific reason, but you are just keeping for the future use. Those are general reserves. So after that, we are going to show our liabilities. So I'm going to show all our non-current liabilities. I have long-term loan, lease, provision, debentures. I'll add them up and I'll show my current liabilities. So I'm going to show long-term loan. Then the question is, aren't those non-current liability? But I'm saying that long-term loan, I'm just talking about the part that will be settled in the next 12 months. So if there's a part that I'm going to settle in the next 12 months, that part should be shown as current liability. Same as applies to lease. That part that will be settled in the next 12 months have to be shown as current liability, or payables have to be shown as current liability under clause. So I'll add them up and I'll add my total capital, total non-current assets, and total current assets together. I should find my total capital and equity. So my total assets should be equal to my total capital and liability. If you eventually find this, that means your statement of financial position has balanced, and this is the most happiest moment for an accountant, for a statement of financial position to balance. So, but it doesn't matter if it doesn't balance. Just make sure that your entries are correct. Most of the times I've not balanced my balance sheet, but I still get a lot of marks because I was doing the right things. So that's to do with this chapter. So that's the end. Then we're going to look at the end of chapter questions.